So we'll get started now. So I apologize. We're going to miss all of Anthony's I-bond stuff, but in the follow-up email, we'll send this recording and I'll make sure that we include that additional information on the tax benefits, Patty.
Yep. And important to note there, by the way, the government has I would argue, especially for a government website, a pretty good website that spells out the details of this. That's where I go to get my information on it. We can provide that link to everybody too, because that's actually the site you go direct to buy these from as well. It's called treasurydirect.gov, and they have fact sheets and frequently asked questions, and you can log in and make your account to buy them right there. From 99% of the people we've worked with have had a really easy time. I have heard one story of someone who had some trouble with it, but I would expect it to be worse if it was a government website. So it seems to be doing pretty well.
Well, potentially it says interest is exempt from state and local tax
I would guess that I think that's fairly typical with government
and
bonds.
can also defer federal income tax on accrued interest for up to 30 years.
Okay,
It's just
so
a deferral.
that's the key then. So to answer the question, so thank you, Jeff. It's the big tax benefit because I have to look at the Minnesota specific laws about the state and local piece of it, but federally, normally in an investment account that's not an IRA or a Roth IRA, right? Just a regular old investment account, you get a statement every year that says you earn this much interest and this much dividends, and you pay taxes in the year you earn it. On an I bond, you do not pay taxes until you take the money out on the gain that's in there. So it's not a yearly tax statement, assuming you want to hold it for more than 1 year. You can wait to pay the taxes until you take the money out, which again, assuming a high rate of interest, which is up in the air because the formula right now is the 6-month inflation rate times 2 plus no guarantee. So if inflation goes back down to very low levels, it's not probably going to be worth it to keep this anymore. It's not going to make enough. But for now, you kind of make hay while the sun shines. It's one way to take advantage of the fact that inflation's high.
Yeah, guess the silver lining.
Yeah, exactly.
In inflation. Speaking of that, I know Anthony, you and I were just visiting about inflation, GDC, what's happening right now. Kind of some interesting news coming out recently.
Yeah. Well, let's circle back because one of our topics we were going to hit to an extent is the political ramifications on the market and the economy. And I'm not here to talk about specific policies or proposals per se, but speaking specifically about the economy, we have been watching very closely what this third quarter, which ends at the end of September, so quarter is just 3 months out of the year, where economic growth is going to be. So forget about the market for a second, economic growth. Now, for the first 2 quarters of the year, economic growth has been negative. And if you took an economics class, that might ring a bell because, when I went to school for economics, a recession is defined as 2 consecutive quarters of negative economic growth. We've had that this year so far. Now, is that me saying we're in a recession? Yeah, I am saying that. However, when you think of the word recession, it's not necessarily a 2008 situation, and that's not at all where we believe we are. There are a lot of things actually to be optimistic about. We can't find enough workers for the jobs that are out there. Inflation is high, and that means people are spending their money. That's the opposite of what happened in 2008. Everything contracted. So what we've been watching closely is the third quarter numbers, and they've been projected and revised. And we only have 10 days left in the quarter. It seems like it's going to be pretty tight, whether we have positive or negative growth. For any of us on this call, what economic growth says might not change a ton about our day-to-day lives. It affects things in the big picture, in the aggregate. But if you're going to ask me, well, what does that mean for the market? What does that mean for my bottom line? In a lot of cases, it might go very under the radar market-wise, or at least in your pocketbook. The market will probably have a reaction one way or the other, but there's actually no way to tell which way it will react. It could react positively, even if the numbers come in negative. Kind of counterintuitive, I know. But where I was going to loop it back into the political world is if you ask Washington right now, are we in a recession? They would say no, because instead of using that classic definition, they now use a committee that looks at multiple different factors to decide whether we're in a recession or not. And hey, looking at as many pieces of data is great. I don't have any problem with that. I like to kind of call a spade. And I think one of the big impetuses for creating that committee was they don't want to use the word recession if they don't absolutely have to. And just to be clear, not a partisan thing. Both parties do this. So it's not a Republican or Democratic thing just because one party is in charge right now. It's a political thing. It's a optics thing. So just so you know, we feel, and based on the classic definition, we're in a recession. That's why we're watching the economic numbers so closely, and the market is too. But not all recessions are created equal, is what I guess I would say. And we may be in a much lighter, that's what we feel, recession than we've been used to in the 2008 or even 01, 02 kind of historical mindset there.
So what's going on today, Anthony? Today specifically? There's a meeting taking place.
Yes.
Isn't there?
So this week and starting today, the Federal Reserve is meeting, and what they are going to decide, everyone expects, is to continue to raise interest rates at, again, everyone expects 0.75% or 0.75%. That number in and of itself sounds kind of abstract. Let's talk about what they're doing, because the whole reason why this is so watched and in the news is because of inflation. So one of the Federal Reserve's mandates as the central bank of the United States is to keep inflation under control. The other mandate, by the way, is to try to promote full employment, whatever that means, because if you ask an economist what full employment means, it doesn't mean everyone has a job. So that gets complicated. But let's talk about inflation. Inflation, we just had some numbers last week where it's starting to come down, but it didn't come down by as much as we expected. And that gave the market some heartburn, by the way. That's why last week was kind of a volatile week. But the Federal Reserve Board is meeting to decide on what to raise interest rates by. And again, the secret is out. Everyone that I've talked to, including our group, expects 0.75 percentage point is what they will raise it by. Every time they have raised rates this year, which has been many times going back to the spring and late winter, the market has gone up to that news. That doesn't necessarily mean it will happen this time. The market will do what it does. But I take that in a broader sense to be indicative of the fact that the market knows we need to raise rates. This is how we get inflation under control. If you think about it, an interest rate is kind of like the cost of money, right? If you're going to buy a house and you take out a mortgage, your interest rate is your costs. The loan amount is how much you have to pay back, but the cost of that money is your interest rate. Well, by making interest rates higher, you make money more expensive, and therefore you should over time slow it down. There shouldn't be as many new home purchases because mortgage rates are increasing. There shouldn't be as much, businesses just borrowing as much as they possibly can to expand, because now they have to think about, well, what is the cost of this borrowing? So the whole goal here is to slow inflation down back to a reasonable level. In the past, they've wanted to target 2%, and we're at 8% right now. So we've got a ways to go. And this is why they're being continually aggressive in raising rates. We expect that announcement to either come tomorrow or Thursday, what the actual rate rise is going to be. But again, it's a pretty open secret right now that it's going to be 0.75 point. It's basically all but signed on the bottom line at this point. That's what everyone expects.
I think it's also really interesting that Europe, we started to see some of those countries start raising interest rates as well, and even finally getting out of negative rate territory.
Yeah.
Which has been, I think, positive for global economics
Right.
in general too.
Right.
So it's been good.
And this
to see
is,
happen.
some of you who have talked to me recently may know I was in Australia over the summer. My wife's family is from there, and we took a trip. And while I was there, they were raising interest rates. So this is a global issue. It's not just the US. And, I think some of the places in like Europe were more aggressive than us in raising interest rate. And that seems, hindsight being 2020, to have been the correct move. You wanted to be out in front of this as much as possible. But, again, hindsight's 2020. And I don't fault us too much for saying, hey, we got to dig out of this pandemic hole before we can worry about fixing the solution to our problem. It's kind of like inflation is the side effect of the drug we took to get out of the pandemic. And the pandemic was the bigger issue. So, if we're thinking of things triage, pandemic, inflation, we're dealing with the second problem now.
Uh, so- okay, so totally switching gears here. I know another one of the questions we had said that we were gonna maybe visit about a little bit is on just the topics of politics. I guess it's not totally digressing because you kind of mentioned it earlier.
Yeah.
But just we've midterm elections, also a time of volatility, not that we've already been seeing it this year, but we're headed into another season of that, I think,
Right.
with the midterm elections coming up. I know, Anthony, you had some thoughts around like house flipping, doesn't flip, what happens, what should we be worried about in terms specifically of the market? Obviously, politically stuff is going to happen.
Yeah. And so two things right off the bat. The market likes certainty. The more it can get, it would take as much certainty as it can get. And while there is an election that's still hanging in the balance, there is to some extent maximum uncertainty. What's the House and the Senate going to do? We know where the White House is going to be, obviously, for the next 2 years. But will the House flip? Will the Senate flip? Will they both flip? What if neither of them flip? And now we have a Democratic House, Senate, and White House. Does that mean more proposals are going to get through? That's a lot of what the market's weighing. Before I talk about some of those outcomes, let me give you some good news, or at least some historical precedent that we can look favorably on. So in a midterm election year, which traditionally is the most volatile year of the 4-year presidential cycle, market-wise, the average drop in the market is 19% at some point before the election. We were down at our worst this year so far, about 24. So a little bit more than average, but not far off the actual average for a midterm election year. From the day the market hits its low, whenever that is, usually it tends to be over the summer, but it can be at any point. From that day to 365 days later, so 1 year later, the market averages up 32%. So it's an average drop of 19, an average up after that of 32. So you dig out of that hole and more. If you look at just election day, November to November, historically, and this goes back to the 60s, these numbers, both of these stats that I'm telling you, from election day, midterms, to 1 year later, so now we're in the 3rd year of a presidential cycle, the market averages 15% growth over that 12-month span. That's historical, right? Every year is different. You can't take that to the bank per se. But one of the reasons why that tends to happen is because elections create more certainty, right? We will know one way or the other in November who controls the House, the Senate, and obviously the White House. We know that right now again. But one of the things, and this is a really cynical way of looking at it, I'll admit, I think the market probably reacts favorably to any of the outcomes of the election this year. Now, I'm not saying one could be more favorable than the other, but I think especially, and this, according to the odds makers, seems like the favorite to happen right now, that the House flips to the Republicans and the Senate stays with the Democrats. Could be wrong about that. I'm leaning on the political prognosticators to make that prediction. But especially if that happens, we probably are looking at the best case scenario for the market, because what the market will assume is that nothing's going to get done, right? If we have one party controlling the House and one party controlling the Senate, the market's going to kind of assume that it's going to be really hard to get at least any big changes pushed through. Historically speaking, I guess I tend to agree with that they tend to deadlock when that happens. So from a market perspective, if you can kind of look at the landscape and say, we got 2 years of easy sailing. We don't have to worry about too many new regulations. We don't have to worry about this or that. And of course, things will happen that will affect the market. But that, I think, is what the market's looking forward to the most. Even that being said, I think if it flipped Republican both Senate and House, or Democrat both Senate and House, I think the market probably still reacts positively, because at least we know what's on the table for the next 2 years. That is the big key market-wise. Knowing what to expect is what the market likes. So an election, beyond advancing a political agenda, gives you more certainty about who's in charge for the next 2 years. That's what the market tends to like.
I think, Kate, I think you were in agreement with some deadlock there happening and nothing getting done.
It's a cynical take. I know. I hate to be the cynical one here, but I think, thinking realistically, that's probably what we're in for.
Anyone have any thoughts or any other comments or questions on that idea?
or anything else.
Yeah, because remember, this is supposed to be just an open dialogue. Anthony can talk forever, so we want to shut him up. So, somebody else ask a question, have a thought.
I do. I just have a quick one. So, Anthony, that was a good thing on House and Senate and what might flip, what might not. How do we factor in executive orders?
It's incredibly hard to factor in executive orders. That's a big, I would say problem. Executive orders can be for good things, right? Politically and for the world, and sometimes they can be for things we would disagree with as well. But from a market perspective, a lot of times an executive order, the nice thing about them is usually they're sort of hinted at ahead of time. Rarely does one come out that just blindsides everybody on the day it happens. I'm not saying that can't happen, but rarely does that. Usually, okay, the White House is thinking about doing an executive order on this. They kind of float the idea to see what the public perception is going to be. That gives the market a little time to prepare. But the problem with them is they're unilateral, right? The president can decide to do them or not. So the market has, until they actually happen, has total uncertainty about whether they're going to happen. Everybody does their best to predict, is this going to happen? Is it going to happen like they've said it's going to happen? Because maybe they do issue an executive order, but it doesn't have as much teeth as maybe it did when they originally floated the idea. That creates uncertainty. So the one nice thing is our system is so large, and I'm talking about our economy and the market, that unless it's a very broad executive order, it doesn't tend to just put the market into one direction or the other. It can kind of, if it's something the market doesn't like, it could kind of chip in to a upswing, or it could add to a downswing, or vice versa. If it's something the market likes, it could add to an upswing and delay a downswing, but it usually doesn't set the trend in and of itself. Obviously, big sweeping things like, in the past, like military action, for example, that can cause a market to have a lot of heartburn. But A, we don't necessarily see that on the horizon, at least not in a unilateral sense from the executive branch. And B, a lot of the things that they do propose that are going to get executive ordered, and I'm no expert on the political agenda of the White House these days, but it's usually stepping stone things. It's not things that'll set the tone of the market for the next 6 months all by itself. So a little
question,
consolation there. Yeah. And it looked like Kay, you were going to have a question too?
Oh, I was encouraged by the bill that passed to. Sorry, I
there we
was
go.
encouraged by the bill that recently passed that's going to put some energy into electric car stations. I think it's going to increase investments in some of the green energy.
It's funny. We were just talking about this yesterday, and because we were actually meeting with a client and asked the question, okay, do we see any economic impact from some of this recent legislation that was passed, the so-called Inflation Reduction Act and things like that? And I said, well, besides the buzzword of the name of the bill, the impacts of those type of bills where they're putting investments into different things are not usually immediate as far as the economy is concerned. So everybody would love to have a magic bullet where, hey, let's pass a bill and the market goes up 10% because of the new initiatives. It's not really how it works, unfortunately. It usually, if there is a positive impact, which always remains to be seen because there's always unintended consequences, even to the best intentions. But let's assume that the result is going to be positive just for a thought experiment. That positive impact usually plays out over, a decade, or maybe a 5-year cycle versus in a given year. So I would agree with you that the more investment we could put into there, certainly that sector of the market probably will do better than it would have if there was no bill. And that can lead to more investment in that area. That could lead to new companies, that could lead to new technologies. All that stuff can benefit us, but more likely in the long run versus in the short run. So I think investment in our businesses and our economy is good. The problem is it's a delayed payoff, which is always a tricky proposition for senators and legislators who need to get elected in their next cycle. So they're always kind of weighing those two things against each other.
Yeah, I think at the end of the day, for me, I know Anthony said a lot of things, but it just, the only thing is just there will be market volatility, and the market historically has just always gone up. You know, we've gone through depressions, we've gone through total economic shifts from being industrial focused to service focused. We've gone through war, we've gone through so many things, and there will be so many more of those things to come. So there will just always be market volatility. Long-term gain is always the end goal, I think, at the end of the day.
Right, right. I mean, and this was a classic Jeff line, but if you, regardless of what's going on in the world, right? And not that that's not important. The politics are important, the world affairs are important, all that stuff's important. But at the end of the day, the market is determined by the companies that make it up. And the CEOs of all these companies and their boards and all their shareholders are waking up every day with one goal in mind, which is, how do I continue to make this company the best company I can? And so there can be headwinds and tailwinds, but ultimately they're working towards being successful. That's what their incentive is. And that's what we rely on as investors to say, hey, yes, there are some companies that are better than others, no doubt about it, but everybody's waking up with the same motivation. How can I do better today than I did yesterday? And that's, you know, what drives us forward ultimately, is that motivation, regardless of what's happening in the world at large.
I guess I'm probably just an optimistic at heart.
Yeah. Well, and you know,
Well, history's on your side.
Yeah, I mean, it just,
Uh,
and then, you know,
Every
there's
time
there's
somebody,
times to worry, but at the same time, I just sit back and I go, okay, it's not exactly the same thing we've gone through before, but this is what's supposed to happen. The market's supposed to be volatile, because that's why then there's gain, and then it's going to grow. So like, this is what's supposed to happen. So then I'm like, all right, we'll just gotta wait it out.
I'm with you. The market 1001 is that we will increase to a certain level where people will say, this is high
Yeah.
or expensive, in which case they will sell off, take their profits. The market will go down, creating now value, in which case people will start buying. And those cycles are of a different length. Each of you either has thought it or has called and asked, what should I be doing? This is, you know, this downturn in the market is making me crazy. And you want to know something, Jeff? It's different this time. And my answer is it is always different. Everyone is different. But at the same time, they're all the same. Now, whether you think it's fortunate or not, I was around for the 1987 market decline and the 2000 and 2001, where we had our dot-com bust, and then we had the unfortunate September 11th take place, where we had for the first time ever a 3-year market decline. I was around for 2008. I was around for
20.
17.
Oh, so, okay.
yep.
And then we've got 2020. These things happen. And money is all about time and need. And it doesn't feel good to see the value, not taking a loss, but the value of your account going down. But at the same time, it's only on paper, and shame on you and shame on me if you haven't communicated to us, or if I haven't asked, what has changed? Should we be shifting your philosophy because you have a specific need coming up? I'm going to help my grandchildren pay for college. We're buying a second home. We're taking a trip where we're taking all the children and grandchildren. I'm going to need X number of dollars. Let's position your money accordingly so that we don't have to worry if the market is up or down. And I'm talking about, if you're saying that that big trip is going to run you $25,000, let's just set aside that $25,000 so you don't have to worry about it. But otherwise, my thought for today is, if you can let the money sit there, it will, I'm very confident, recover for you. And we will be having much more pleasant conversations next year as we talk about what are our next opportunities. You also asked about kind of the green wave as would relate to the EVs, electronic vehicles and things like that. Anthony's exactly right. It looks good on paper today. It will look better as an investment 3 years from today. So if you're saying, I really want to get in on this battery manufacturer or this company that installs these charging stations or things like that, all of those need to have their momentum built up before a year into it. If we had gotten into it today, you're going, well, nothing's happened with this thing because it takes time to build up that momentum. But maybe a year from today, maybe 2 years from today, those rare metal miners or those new battery manufacturers, or all of a sudden one of the car manufacturers will kind of separate themselves from everybody else as really becoming the leader in producing electronic vehicles. Well, let's just keep an eye on those type of opportunities and take advantage of them when the time is appropriate. So that's what I'd like to kind of leave you with today, is just enjoy each day. If you need the money, let's shift things around in order to take that into account. But otherwise, it's just another thing that really is only impactful to you emotionally. And if you can take that step back, it's going to be another nice day out there for you.
Yeah, so again, any more questions? We want to make sure that you guys are getting plenty of opportunity to visit and share your thoughts, even if it's just a thought or a comment. We would love to hear it. Have you guys join the conversation.
And that's okay.
Nothing. All right. I was gonna say also, we kind of mentioned earlier, the idea of taking your RMD, maybe you invested in an I bond. I'm a little behind actually on the Secure Act 2.0. Did it make its way through yet? Did we get a raise in RMD? I haven't heard that, so I'm assuming
Yeah.
not.
So speaking of politics, this is something that could affect a number of people on this very call. So in 2020, the House and Senate, and was signed into law, passed what's called the Secure Act, which among other things, it did a number of different things. One of the major things is that was the bill that raised the required minimum distribution age from 70 and a half to 72. So everybody had spent all those years learning that weird 70 and a half age, and then it got outdated. Well, they are working on what they are calling the Secure Act 2.0, which again is not just about the required minimum distribution age, but that is one of the other things in this new bill that they are thinking of raising. So right now, it is working its way through the Senate, I believe. It has passed the House. Could have that backwards. It's passed one of the houses of Congress. I believe it's passed the House, and the Senate is taking it up this fall. We do believe some version of this bill would pass. And one of the big factors that it would impact for a lot of people, if you haven't already started your RMD, because likely everybody would be grandfathered in.
That's the key.
Yep. Is 75 might be the new age for your first year of required minimum distributions. Now, again, key caveat, if you have already started, you would likely be grandfathered into at least the 72 rule. And again, if you'd already started when they switched to 72, you were grandfathered into the 70 and a half rule. But for those of you who aren't yet in RMD age,
Grandfather, not in a positive sense.
yes,
It's actually more
Right.
like, no, you have to stick with the current rule standing. You don't get to take the new one if
Yes.
you're already taking.
So we're watching that closely for the RMD age is probably one of the bigger impacts. There's always little things tacked into this bill. Another thing that was in the bill, and I'd have to go back and look if it still is, and it may be removed by the time they pass it anyway, is we've talked a lot over the past few years with the way the tax laws has changed in 2017 about qualified charitable distributions. And that is giving to charity out of your IRA to satisfy your RMD. So basically, a qualified charitable distribution is the answer to the question, is there any way I can satisfy that RMD without paying taxes? There is one way currently, and that is giving money to charity out of your IRA satisfies your RMD, whatever amount you give, and you don't pay taxes on it. It's only available for people who are over 70 and a half. It's still tied to the old 70 and a half age, even more confusing. Regardless, one of the things that they are thinking about changing, this is right now possible for IRAs. It is not possible for 457s, 401ks, 403bs. They are thinking about expanding to those type of accounts, this same procedure. I don't know whether that will be in the bill when it passes. Honestly, they don't know whether it will be in the bill when it passes. That's what they're going to argue about, among other things. But we do expect, at least last I've heard, and again, I'm not a legislative expert, we're taking our cues from people who are, but we do expect some version of this bill to pass probably in the late fall, early winter part of the session. That's when most places. So basically, I would expect if it does change and anything material on your end changes, we will be putting out a notice saying, hey, this law just passed. It was signed into law. Here are the things you need to be aware of with the new law. So basically, we'll keep you updated. But that among the actual legislative bills going through the Congress right now is probably one that we're watching most closely at this point.
So the bottom line, if I'm charitably inclined and I have to take required minimum distribution, I don't need the money. I'd rather send it someplace else. You can let us know, and we will have that distribution sent to or however many organizations you'd like. Sorry about that, Margie.
I was just gonna say, let's be clear,
So-
Margie's gonna make the magic happen
That's
and
right.
get this done.
But you can choose multiple organizations to benefit from your
Mhm.
generosity. The distribution happens and it is a non-tax event for you. So you are benefiting in charities and benefiting from a tax standpoint. Just, something to take into account.
Yeah, and I would also say it wouldn't necessarily have to be that you don't need your total RMD. Let's just say you're already charitably giving at nature. Maybe you give to your church on a regular basis, or you give at the holidays to a specific organization some amount. You could just have then part of your RMD for that time period go to that organization, and then you just get that income tax benefit, which would be small. But hey, if we all don't want to pay taxes, it's most people's feelings anyway. It could be a way to do that if it's something that you already participate in, which I think is just a really cool opportunity. And one of the only alternatives to taking your RMD
Right,
that's out there.
right.
Which aggravates most of you because you tell us, I don't need this money. I don't want this money.
So if we're looking for other solutions, we've got the I-bonds
Yeah.
is a good place to hold maybe some cash. We could just give that RMD to a charity to avoid some income tax, plus it gets put to good use. We can come up with other ideas too, if you want them, but
Yeah. Yeah. And it's all about, we want to encourage giving as much as you want to do it. And it just so happens that for people who are older than 70 and a half, this is an actually really advantageous tax way to do it too. So it's kind of a win-win. You get a benefit and the place you want to support gets a benefit too.
Paul, did you have a question or a thought?
Yeah, I have one. One is, I thought that the 457 was included in this, but then when you ran through some numbers there, Anthony, I think you excluded 457 as being a possible method to make the charitable contribution. What is, can you clarify that?
Yes. So under current law, the only account that you can make qualified charitable distributions out of is an IRA, not
Okay.
a 401k, not a 403b. However, that is one of the things they are thinking about changing. I don't know whether it will change or not, but with the Secure Act 2.0 that we talked about. So for right now, you can only do it out of an IRA. However, 457s, 403bs, 401ks are still subject to required minimum distributions. So you still have to take the money out. You just can't go direct to charity from those types of accounts. We have had plenty of people who have looked at that problem and said, well, can I put my 457 into an IRA and then I have the same RMD, but I can then give it to charity? And the answer is yes. So that would be one of the reasons, at least under the current law, that you would want to transition from a 457 to an IRA or from a 401k to an IRA. Basically, you can only do that from an IRA at this point.
Okay.
And it's only on your required minimum distribution.
So you can go above the required minimum distribution. So a lot of people ask this, and if you're so generous, that's fantastic. You can do qualified charitable distributions up to $100,000 per year. And actually, I haven't had too many people where $100,000 is their RMD. So I don't know if you can do your whole RMD if it goes over 100,000, but regardless, you can do up to 100,000. So if your RMD is less than that and you want to give more, you can. However, we want to make this work for you the best tax way possible. We'll kind of analyze the details as your circumstances allow.
Well, we've been chatting for quite some time, but I'd like to continue chatting. I'm going to, though, get together our coffee wheel to make sure someone gets a cup of coffee on us today for joining us.
Yeah, if you don't know,
Give me a sec to do that while you guys keep chatting here.
So and this I assume was advertised in our sign up link, but everybody, we have a big, wheel of fortune with everyone's name on it. And we will give you, whoever wins, a free coffee gift card. So it's a little incentive to join us. But we talked a little bit about where we see the market, where we see the economy. I will say, and I'll speak for myself, optimism, maybe cautious optimism, does tend to be where we're at these days. The consensus out there, and this is just a consensus, it's not something you can plan on or anything like that, is for the market to recover from where it's at today back to, let's say, January of 2022 is, maybe 6 to 9 months away. That's the most common answer I've seen from people I've talked with. And of course, that's just a prediction. We don't know for sure because lots of things can happen between now and then. I'll say for myself, I do tend to be on the more optimistic end of that. I don't have a number to quote you necessarily, but I gave you those few statistics from election years past, midterm election years past. I do think we're probably in a position where, we may be set up for a nice bounce, pending that we get inflation under control. And that's really been the big issue this year. That's why the Federal Reserve, we expect again in the next day or two, is going to announce that they're going to raise rates. And again, the market's reacted positively to that every time they've done it so far this year. So we're hoping that inflation gets under control sooner rather than later, and we can get back to some kind of a slow and steady growth. I don't think it's going to be, anything to write home about, the level of growth we're going to see. But positive growth is positive growth. And that is kind of where we expect to go from here, at least in aggregate. There's going to be plenty of ups and downs along the way, though, like we've seen so far this year.
I guess I'm just curious, just in general, unless anybody's got any other questions, just how everyone's feeling right now. I don't know, raise a hand. We're all feeling okay with what we've got going on. We're going to hold the course. We're feeling good. Awesome. That's fantastic. Fantastic. Lastly, too, here before we spin the wheel and say goodbye this morning, as a reminder, as part of our educational series, next month we will be having our Medicare conversation. So that one should be really great. Lots of questions kind of right in time for open enrollment and changes and anything like that. So if you're in that space or any friends or family that are, by all means, invite them to join us next month for the Medicare webinar. That should be a really good one. All right, let's spin the wheel.
Share our screen so you can see in here.
All right, here we go. Oh, lucky Bill.
Bill, you just got it. Congratulations, Bill. There's some coffee on us.
Awesome.
There we go.
Awesome. All right. Well, thanks everybody for joining us this morning. Hopefully we'll see you at the next quarterly coffee chat. It'll be, well, actually, no, we're going to skip December. Sorry. We kind of skipped the end of the year because of the holidays, but we'll see you guys back in the new year already for the next coffee chat. So thanks for joining us today.
If there are individual questions you want to be asking, clarifications, just either call us, drop us a note. We're here for you.
Yes.
And just have a great day and a great week here. Look forward to talking to you soon.
Bye, everybody.
Thank you,
Have a
everyone.
good day.